Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamond Show mid-month market update for, actually, I guess we're getting into April 2016. I'm here with the expert economist and wealth advisor, Paul Sloate, a regular on the show here, founder of Green Drake Advisors. Each month, Paul joins us on the show here and enlightens us to the economic forces at work in the national and global economy and what those forces are expected to do to the local real estate investment markets in the short and long term. Paul, welcome to the show.
Well, thanks, Dan. Glad to be back.
Appreciate you being on here. So I'll let you take it away and give us the monthly update.
Okay, so the monthly update, we'll just talk a little bit about some overall things that have gone on. Firstly, Q1 growth is going to be pretty poor in the U.S. If you believe the Federal Reserve. According to the Federal Reserve, economic growth in the first quarter was 1% or less. Depends which Federal Reserve Bank you want to listen to. We now have two competing Federal Reserve banks that giving two different forecasts. So growth was pretty weak. However, what we had at the end of the quarter and into this quarter is a pretty big rally in the equity markets. And as we know, the equity markets are usually a pretty good leading indicator on the economy. As we talked about in previous podcasts, the U.S. economy was expected to slow in the first half as a result of the drag from all the commodities. So, and it's not just oil, it's things like agriculture as well, because the farmers are having problems, and that can be seen in the number of tractors they're buying or whether it's irrigation equipment. They've really cut back on buying that equipment. And in fact, it's projected if prices remain where they are for corn and soybeans and wheat, that the farmers will lose money this year for the first time since early 2000s on every acre they plant. So while the commodity pressure is not going to go away, it's probably not going to be a huge incremental drag on the economy given where commodity prices are. And in fact, oil prices have had a pretty good rally from the mid to upper 20s up to about $40 a barrel. Part of this was because the price in the low 20s was unsustainable, but over the near to intermediate term, it will probably be hard for oil to get much above $40 to $45. However, with that bounce in oil, you should get some kind of bounce in activity in the oil patch, despite the expected bankruptcies that are out there. So we think this drag that's happened on from the commodity area is going to lessen significantly by the second half and may even turn into a tailwind. At the same time, the leading indicators for manufacturing are indicating that the inventory correction that was going on in the U.S. and around the globe is coming to an end, and the new orders number for manufacturing was very strong, is released by the Institute for Supply Management that used to be called the Purchasing Managers Institute. So when we called it the PMI, everybody knew that it was the National Association of Purchasing Manufacturers. When we call it the Institute for Supply Management, it can be many things. But their data indicate there should be a good bounce in manufacturing as their new orders were strong at the same time as inventories are still shrinking throughout the economy. So as we look forward, we would expect the economy to begin to accelerate sometime in the second quarter and get stronger as the year progresses. This should be helped by some things that are going on overseas. First, Europe is growing at an okay rate. They never grow at a really fast rate, but an okay rate is better than what they had over the last few years. So Europe should be a net positive to U.S. growth. And the other big factor that should be a swing is China. Now, China, as you know, we have been very negative on for some time as there's a major adjustment that needs to go on in their economy. and that has had repercussions around the globe for global economic growth. However, the government there is stimulating the economy in a significant way. Infrastructure projects started are up 25% year over year, and we're starting to see the salutary effects of that incremental infrastructure spending already on their economy. And as their economy picks up, the drag on the rest of the world should diminish and should help global economic growth. The last wild card we would mention is what's going on in Brazil. Brazil, as you know, has been having what is effectively a depression. Their economy is down 12.5% or so on GDP from its peak and probably will continue lower. However, it appears manufacturing and agriculture are bottoming out at extremely depressed levels. What's holding the economy back is that the central bank is not going to ease until a more business-friendly administration shows up in Brazil, and that may happen over the next couple of months, because the current president in Brazil is about to be indicted by the Congress, brought up on impeachment charges, and likely will have to resign the presidency, especially as the ruling coalition is falling apart as numerous parties are defecting. So assuming there is a change in government sometime in the next few months, it's likely the Brazilian central bank will start to reverse its tight monetary policy and begin to loosen and help encourage a budding economic recovery in Brazil. That should help growth later in 2016 and especially in 2017 as Brazil reaccelerates as the biggest economy in South America. And with Brazil reaccelerating, it should also have a positive impact on other countries in the region, especially Argentina. Argentina is already benefiting from the depreciation of its currency as it is now one of the lowest cost producers of corn in the world. So its exports have accelerated significantly. But in addition to that, they produce and sell a lot of automobiles that go to Brazil. The sales to Brazil year over year are down around 40%, so that's having a pretty negative impact on their economy. However, assuming the Brazilian economy bottoms out and starts to grow, it should have a positive impact on Argentina's economy and on many other economies throughout the region, thus accelerating growth across South America, which also should have positive impacts on the United States. So if we were to look at the global setting, it's not great now, but it's probably going to get a lot better by the second half of this year. And that's important because it should help to accelerate U.S. economic growth, especially with the Fed basically on hold till after the U.S. election this fall. And the dollar, which has weakened some, may have a little bit of a rally here as some of the foreign countries are trying to hold back the incipient appreciation in their currencies. But the U.S. dollar is still fairly overvalued and should drop somewhere around 15 to 20% to fair value. Assuming the U.S. dollar even begins to do that and drops half of that way, it would be a positive for U.S. manufacturers and U.S. exports. From 2 years ago, if we were to look at the data from the port of Long Beach and out on the West Coast, some of the other ports, U.S. exports are down about 13% over the past 2 years, and that's a major drag on our manufacturers. So, assuming the dollar weakens a bit and the U.S. economy strengthens a bit, manufacturing could get better, which would add to what's going on with the federal government getting better and spending money for the first time in a number of years, and other parts of the economy, such as construction, doing quite well. If we were to turn our eye to the real estate area, what we're beginning to see is that as we forecast, multifamily rents are beginning to peak out and weaken a bit. We have on-the-ground data in cities such as New York and Houston, as well as Philadelphia, that multifamily rents are beginning to weaken, and landlords are beginning to offer incentives to renters as significant amounts of capacity that are under construction are beginning to come on stream. We expect this capacity to continue to come for the next couple of years as the banks are willing to allow builders to build properties, stabilize them, and then refinance them based on the cash flows. As long as those cash flows are strong, the builders are able to effectively take out 100% of their investors' equity and take out a promote for themselves, which allows them to have absolutely no equity in the building and collect an income stream off the building. So we expect building to remain strong in the multifamily at least until the next recession. And even when we get to the recession, you'll still have the lag impact of buildings under construction that will get finished. So let's talk about recession. As you know, Dan, we've been talking about a looming recession out later this decade. As best we can tell, it's going to occur either in 2018 or maybe 2019, depending on what the Fed does and what goes on in the economy. We're waiting to see what the Fed does, but just so our viewers have some concept of what happens in a recession to various asset classes, we'll talk about what happened to REIT earnings during the last recession in 2009, 2010. The areas that did especially well, which you would expect at some level, are healthcare, where FFO growth was only minus 4% in 2009 and then was positive 2.6% in 2010 before accelerating to 14.3% in 2011. Another fairly strong performing group was manufactured homes. As you know, manufactured homes have become a much smaller portion, but still an important portion of the housing stock. Manufactured home REIT performance actually was strong in 2009 with FFO up 9.6%, and then they only had a small drop in 2010. We think part of that is related to the significant down payments that are required by the manufactured home builders, or manufacturers, I should say, that manufacture the manufactured homes. Those builders require buyers to put down 20% in order to get a mortgage from the manufacturer. So there's a big incentive for people to actually not default. So manufactured homes was pretty strong. That same 20% continues in the manufactured home area. Another area, not surprisingly, that's been strong and was strong is the self-storage area. FFO was only down 4% in the last recession and then rebounded a little in 2010 before growing 16% in 2011. And we know that self-storage, the amount of new self-storage capacity that's being built is fairly limited. So in a recession, this area should probably do well again. So in the last recession, let's talk about what happened to apartment. Because we're now having a lot of building in the apartment area, a lot more than was going on in the early 2000s. So if we were to look at it, apartments actually saw their FFO or rents down in 2008, and then they were down strongly in 2009 by almost 10%, and then they were down another 5% in 2010. So what you saw was the funds from operations drop 20% or so at the operating level for apartments in the last recession. Now, in the last recession, we didn't build a lot of apartments. So I would expect that this performance would be much worse in the next recession, where the FFO for some of these apartment REITs could be down 25 or 30%. So as our viewers are investing in multifamily, they should think about that, because that could impact, the economics on any investment they're making today in multifamily in type of apartment. Now, Let's look at a couple of the other classes that had trouble. The malls had a lot of trouble in the last recession. They found their cash flows down 25 to 30%, and that was even before the internet was having such a big impact on them, which it is today. So in the next recession, their cash flows could be down 25, 30% or more. The one area that got hurt very badly in the last recession, actually much worse than the apartment area, was the lodging area. What you found in the last recession was that lodging FFO dropped somewhere between 50 and 60% for those companies. And that's because lodging's a highly levered piece and occupancy drops like a stone when there's a recession. Businesses cut spending, and one of the easy areas to cut is travel. So the number of nights at hotels gets cut significantly. Shopping centers are similar to malls, so we won't talk about the shopping centers. They had a similar drop to the malls, maybe a little more. But the other categories that really got hurt were industrial, which makes complete sense, because industrial companies in a recession don't earn much money, and they're highly levered to economic growth. And the other area that also took it on the chin in the last recession was office. So the office area got hit because of the massive rise in unemployment. We don't think you'll have such a big rise in unemployment as last time. You'll have a rise, so probably office won't be a disaster, but it will still have a negative impact from the economic cycle. So as we look at all these different classes of real estate, it's quite interesting that things like manufactured homes or self-storage look pretty good to us over the intermediate term, besides housing, which we continue to like. The latest data that we see show us that the millennials are continuing to move into housing, as we now have another quarter where the percent of millennials owning homes has increased. We've also seen some people have objections talking about the level of student loans and how that's going to impact the millennials. When we look at the actual data on student loans and student loan payments and add those to your typical mortgage payment, what happens is actually the total burden on millennials relative to their incomes is actually less than it was for first-time home buyers in the early 90s. So we think when people talk about student loans impacting home buying, we think it's a red herring. So we would just ignore it and just look at the data, which says that that's not what is. So the only other thing that we would mention in terms of housing and apartment rents is that the latest data we see still show apartment rent at over 100% of the cost to own a house. When we look at that, what that says to us is that housing still the significantly preferred investment vehicle, as the norm over the long term is around 90%. So we would expect that norm to be restored over the next 5 years, where housing and apartments sort of equate. And here's the only other thing that we would comment on. The Federal Reserve wants us to have higher inflation. Higher inflation ultimately means higher interest rates. As you look at real estate, you really have to think about higher real estate, and what that means is for higher real estate interest rates, we have higher cap rates. And higher cap rates means we have lower multiples on the cash flows coming out of various asset classes in the real estate area. So we think investors should keep that in mind, because over a 3, 4, 5 year time horizon, interest rates should rise as inflation rises and as the government wants to create faster economic growth, because we know that faster economic growth is actually correlated with higher levels of inflation. And the whole populist thrust that is going on during this election season I would use the phrase, you ain't seen nothing yet. We think that's going to have more and more impact, and economic goodness is going to get spread around the universe of people in the country as opposed to the top 0.1%. And as this economic goodness gets spread across the country, what will happen is wages will rise faster, which will cause faster growth and also cause faster inflation. As you get some wage inflation that will then feed into the price of goods. So as we look forward, we see higher inflation ahead, higher interest rates ahead, and you better understand what you're doing in the real estate business in order to do well, because not every class is going to do well over the next 5 years, as happened over the last 5 years. And that's it for my update today, Dan. I hope your listeners find this of value.
I think it's great. And I just want to ask one or two quick questions here, if you don't mind. Do you have a second for me, Paul?
Sure.
So you said the housing and the apartment rents are 100% or more of the cost of ownership. Will the new balance or the historic balance of 90%, in your opinion, be restored from lowering of rents due to the supply increase, higher prices in the housing assets, or both, or possibly the interest rates? What will be your take on what will be the cause of that balancing over the next year or couple of years?
I think it's going to be a combination of all three. I think rents will come under a little bit of pressure, and what will happen is I think it's a long, slow bleed for rents, because rents right now are at about 30% of income, which is the high end of the historical norm. The norm is 25%, and in the last recession, we got down to 21%. So I think it's going to be a slow bleed for rents relative to incomes. And if you go back to the late 80s, that's kind of what happened. It was a slow bleed at the same time as housing continued to recover. And the cost of housing and financing everything will slowly go up, but part of that will be due to inflation, right? So the real price is really going to only go up as fast as real wages go up, but I think real wages will go up at a positive rate, which has not happened, by the way, over the last 8 years. They've actually gone straight down since 2007. So I think you're going to get higher real wages, plus you're going to get some inflation component that's going to feed into housing prices, and housing prices will go up slowly at the rate of, let's say, wage inflation. And part of what will cause this to normalize is housing prices going up, probably rents not going up that much, and interest rates going up. That answer the question?
It does. It does concisely. And my final question is from the 08, 09, and, the latest recession that we went through, all of us in America are burned with that memory of the catastrophic falling of prices. Do you believe that we will see that in that asset class, or if you could pick one asset class that might be overbuilt and would be the most catastrophic asset class in the next recession, what would that be?
Well, it's a little hard to say, okay? I think the biggest risk is with this apartment class, and the reason is that cap rates are so low. Rents as a percent of income are as good as it ever gets. Occupancy is as good as it ever gets. Last time you had this was the late 80s when the baby boomers entered, right? Costs have been pretty much in check because wage inflation has been non-existent. I don't see the same problem for housing because we basically haven't built enough housing units. So at some level, housing shouldn't take it too hard in the next recession, but apartments could, and especially if rates rise over the long term, it's a problem.
Yeah, it'll be more like the real estate market throughout probably the 1990s, then that slow, not a tremendous amount of growth in the price of houses until we got to the 2000s, right? We probably would forecast something like that. Great. Perfect, Paul. Well, I appreciate you coming on and giving the knowledge here. Why don't you share some contact information if there's anybody listening that would like to get in touch with you or your company, and just kind of tell everybody what you do one more time?
Okay. Thanks, Dad. Yeah, my name is Paul Sloate, and my company is Green Drake Advisors, and we're located here in Wayne, Pennsylvania. We can be reached by phone at 610-687-7766, or you can go to our website, and there's a way to contact us via the website. That should work for our viewers. Those are the two best ways to contact us, and what we do is we're involved in doing wealth management, and we also advise our clients on what's going on in their businesses, as we have a very diversified roster of clients, anywhere from auto dealers to people in construction to people in manufacturing to people who own service businesses. Thank you.
Nice. Thank you for coming on the show, Paul.
And I look forward to speaking to you next month.
Sounds good. And thank you for listening. As always, you can check out past REI Diamond Show episodes at www.reidiamonds.com. Thanks again for listening. Dan Breslin here. I'll catch you next time. Remember, here at the REI Diamond Show, we are dedicated to bringing you the experts, ideas, and strategies for increasing and protecting your net worth.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.